Robert, let's start today with this week's Fed meeting. As expected, no interest rate hikes. However, what else did we learn about what the Fed is expecting for the rest of the year?
Well, Susan, it's been a busy week, and the Fed announcement came out as expected with no rate hike, as you said, but we learned a lot in terms of the Fed's forward-looking expectations for the economy. They revised down their GDP forecast for 2019 again. December was a downward revision, and now March is a downward revision. They also told us about their forward-looking expectations for the Fed funds rate. They gave us a new dot plot, and that dot plot is consistent with 0 rate hikes in 2019 and only one more total over 2020 and 2021. So that's a pretty flat dot plot, and that's been consistent with our outlook here for the last month. And then finally, the Fed told us about balance sheet reduction, that process will come to an end this year. They'll wind that down beginning in May through September and into the fall. And so the Fed is trying to get normalized here on its balance sheet and remove that from consideration as time goes on.
Robert, you mentioned today in your report, you discussed what's happening in another country, Germany specifically. How does that relate to what's going on in the United States?
Yes, we saw Purchasing Managers Index for Germany, and that's one of those diffusion indexes that centers around 50. If it's above 50, things are good. Below 50, things are bad. And so that's for German manufacturing. That came in at 47.7, so just below 50. So it's a weak number, indicating more stress in the German manufacturing sector. And what that has done is that has lowered expectations for German growth, and that's brought the bond market, that's German treasury bonds, German equivalent of US treasury bonds, down, and that's brought US treasury bonds down as well. So today, what we're seeing here is a combination of the flat line for the Fed and the weak data out of Germany, bringing US bond yields down, and we see some inversion here in the bond yield curve, and we also see a very weak stock market today.
Let's pivot to some good news that we had this week.
Yeah, we saw existing home sales come back up, and the housing market looks like it's responding to lower mortgage rates. That's one of the benefits of this flat line from the Fed and lower US Treasury bonds, is that the mortgage market has come down as well. So lower mortgage yields bringing some people back into the housing market, and so we saw existing home sales for February come back up. I expect new home sales also to do well for February.